Welcome to Talk Tickers. We're your guide, really digging into the key takeaways from the latest earnings calls.
That's right, cutting through the jargon.
Today, we're diving deep into Invesco's second quarter earnings, and this was a period that, well, it really stands out.
It certainly does.
I mean, amidst all that market volatility we saw, Invesco didn't just, hold steady. They actually hit record assets under management.
Which is pretty remarkable given the backdrop.
It really is. So the question is, how did they manage such a solid performance when, frankly, a lot of others were just trying to keep their heads above water?
Yeah, it's a fascinating story. And the numbers, well, they definitely back up that resilience you mentioned.
Let's hear them.
Okay, so Invesco reported $15.6 billion in net long-term asset inflows for Q2.
$15.6 billion, okay.
Which works out to an annualized growth rate of about 4.7%. Pretty healthy.
That's solid organic growth.
Very solid. And what really catches the eye is they hit a new record, $2 trillion in assets under management by the end of June.
$2 trillion. That's a huge milestone.
It's a massive number. And importantly, it wasn't just those inflows. A big chunk also came from market gains, which really speaks to the sheer scale they operate at now.
Right, that leverage to the market itself. But it wasn't just about the AUM number growing, was it? I mean, these results seem to hint at some real operational strength underneath.
Absolutely. You saw adjusted operating income climb 3% compared to last year.
Okay.
And maybe more importantly, operating margins expanded by 30 basis points. Up to 31.2%.
30 basis points is a nice jump in this environment. And the earnings per share.
Adjusted diluted EPS came in at 36 cents.
So for you listening, when you see that combination of, growing assets, growing income, and expanding margins, especially when markets are choppy, what does that really signal about how they're running the business?
Well, it signals discipline, doesn't it? Seeing income and margins tick up when things are tough, that's usually a sign of pretty tight management. And the tone from the management team on the call really echoed that. They stressed strategic progress, strengthening the balance sheet, and really keeping a lid on expenses.
So not accidental growth.
Definitely not. It feels like a very deliberate strategy, positioning the firm not just to weather the storm, but maybe even capitalize as things, continue to shift. They're building a stronger base.
Okay, so let's unpack some of those key financials and the business highlights, because the details, that's where you really see how they pulled this off.
Agreed.
Starting with that asset growth. Total AUM jumped by $157 billion. That's 8% just from Q1.
A huge quarterly increase.
Now, a massive slice of that $126 billion was just market gains. But here's what jumped out at me. $52 billion of that gain came from one product, the QQQ ETF.
The $52 billion.
What does that concentration tell us about their ETF business, specifically QQQ?
It just highlights the sheer dominance of that flagship product. QQQ isn't just another ETF. It's almost a market utility at this point. And its performance obviously gives their overall AUM a significant boost when the NASDAQ does well. But let's not forget the other piece. That's $16 billion in net long-term inflows.
Right, the new money coming in.
Exactly. That's actual organic growth, showing they can still attract capital even when investors are feeling a bit nervous. So you've got both market tailwinds for key products and solid inflows. It's a powerful combination.
So how did that flow through to the actual P&L? Because, sometimes growth can be expensive.
Well, this is where their efficiency really shows. Net revenues climbed to $1.1 billion. That's up $19 million year over year, mostly thanks to that higher average AUM.
Okay, revenue up. What about costs?
That's the key part. Adjusted operating expenses stayed incredibly well controlled. They were up only 1% year over year.
Only 1%?
Yeah, and if you strip out the currency effects, they were basically flat.
Flat expenses while growing AUM and revenue. That's impressive.
It really is. It shows they're running a tight ship. Growing the top line while holding costs steady, that flows directly to the margin expansion we talked about. It's classic operating leverage playing out.
And speaking of strength, let's talk balance sheet, because there was a pretty major move there that caught my eye, and probably yours too.
You mean the preferred stock repurchase?
Exactly. They bought back that $1 billion chunk held by MassMutual, funding it with bank term loans. Now, for you, the common shareholder listening, this isn't just moving deck chairs around, is it?
Or absolutely not.
Yeah.
This is a very smart strategic move. By taking out that preferred stock, they're essentially plugging a leak in the earnings bucket.
How so?
Well, they expect to cut their preferred dividend payments by nearly $14.8 million to be precise every single quarter, starting now in Q3.
Okay, so that $14.8 million.
That money used to go to MassMutual. Now it effectively becomes available to us, the common shareholders. It directly boosts the earnings per share.
Right, a direct uplift.
It's a clear signal of confidence, too, and it gives them way more flexibility in how they allocate capital going forward.
And that flexibility shows up elsewhere, too, right? They didn't just stop there. They're also buying back common stock.
That's right. Another $25 million in common shares repurchased in Q2. So it's a kind of two-pronged approach to returning capital.
Preferred buyback and common buyback.
Exactly. And looking at it, they set a target aiming for a payout ratio near 60% for 2025.
60% payout ratio. What does that imply?
It implies they plan to return roughly 60 cents of every dollar they earn back to shareholders through dividends and more buybacks. That's a pretty clear commitment while still leaving room to manage debt and, invest in growing the business. It feels like a mature approach to capital strategy.
Okay, so beyond the numbers, let's shift gears to the strategic initiatives management talked about. It sounds like they're making some fairly significant moves to set themselves up for the longer term. What really stood out for you there?
Well, the partnership with MassMutual and Barings was definitely a highlight. MassMutual is planning to invest $650 million total into Invesco's private credit strategies.
$50 million? That's a serious commitment.
It is. And it starts with $150 million going into their dynamic credit opportunity fund right away. But it's not just about the money itself.
What else?
It's about leveraging Invesco's existing private markets platform, which is already substantial, about $130 billion. This partnership helps them expand their offerings, especially tapping into that lucrative U.S. wealth channel for alternatives. It's a smart push into higher growth, potentially higher margin areas.
What about their more traditional business, the fundamental equities side? I saw something about a realignment.
Yes, they did announce that. They're basically consolidating their fundamental equity capabilities under a single chief investment officer.
Why do that now?
The goal is twofold. Try to strengthen investment performance, obviously, but also gain efficiencies. It's frankly an acknowledgement of the pressures active equity faces, particularly in the U.S. market. The secular shifting demand challenges, as they put it.
Right, the move to passive and lower fees.
Exactly. So this is a strategic move to optimize that part of the business. Making some tough calls, probably, but necessary to stay competitive in that space.
Okay, now here's something really interesting, especially for a fund as, iconic as the QQQ. Invesco filed paperwork seeking approval from QQQ owners to reclassify it away from being a unit investment trust, a UIT, to just a regular open-end ETF.
Yeah, this one's fascinating.
It sounds kind of technical, maybe a bit dry, but what's the real strategy here? Why now, after 26 years as a UIT, and what's the potential impact?
Right. It's definitely not just a technical tweak. This is a significant strategic maneuver. That UIT structure, it has certain limitations operationally and critically in how revenue gets recognized.
What's that?
Okay, so currently QQQ has a 20 basis point fee.
Right.
But because it's a UIT, most of that fee gets offset. There are licensing fees, marketing costs to get reimbursed, trustee fees. The net result is that very little of that 20 BPs actually hits Invesco's net revenue line.
Okay, so they don't capture much of the headline fee.
Exactly. Now, if this reclassification gets approved, the new proposed fee is slightly lower, 18 basis points. But the key difference is that most of that 18 BPs would be recognized directly as investment management fees on their books.
Ah, so it changes the accounting and the actual revenue capture?
Precisely. And management was very clear on this. They expect the equivalent of 4 basis points from this change to drop straight to the bottom line.
4 basis points, straight profit.
With virtually no extra operating costs tied to it. On a fund the size of QQQ, 4 basis points is, it's a lot of money. It's a pure high-margin boost to operating income.
So it's almost like finding free money tucked away in the structure. A big earnings lift without needing a new hit product.
That's a good way to put it. It's a clever, potentially very powerful move for expanding their margins. And beyond QQQ, they're also spending on operational upgrades.
Right, the alpha platform implementation.
Yeah, they're going with a kind of hybrid approach, using State Street for the equity side and BlackRock's Aladdin for fixed income.
That sounds complex and expensive.
Well, there are implementation costs, sure. They flagged about $15-20 million for Q3, dropping back to maybe $10-15 million in Q4. The whole thing should be done by the end of 2026. But look, this isn't just IT spending for the sake of it.
It's strategic.
It's strategic. It's about optimizing their whole trading and portfolio management infrastructure. Ultimately, that should lead to better results for clients and, again, more operational efficiency for Invesco down the line. It's a long-term investment in scale.
Okay, let's pivot to the flows across different segments because that really tells the story of where the growth is actually coming from across their big, diverse platform.
Yeah, the flow picture is always revealing.
No surprise, maybe. Their ETFs and index platform was on fire. $12.6 billion in net inflows.
Huge number.
That's like a 10% annualized organic growth rate.
Yeah.
Just phenomenal. And QQQM, the sort of younger sibling to QQQ, led the way with record inflows. $5.66 billion, pushing its AUM over $50 billion now.
Yeah, QQQM's growth is really something.
Why is that one specifically taking off so much?
Well, it speaks to who's investing now, right? QQQM is basically the same underlying index as QQQ, but has a slightly lower fee and, crucially, a much smaller share price.
Makes it easier for smaller investors.
Exactly. More accessible for retail folks, maybe those doing dollar cost averaging, building positions over time. Its growth really reflects that strong retail demand and the ongoing shift to low-cost index funds.
And it wasn't just QQQM and ETFs?
No, their factor ETFs do well too, particularly momentum and quality strategies. That shows they've got some smart diversification within their ETF lineup, hitting different investor needs.
Okay, what about fixed income? That's been, a bit more challenging for managers recently.
Well, their core fundamental fixed income group pulled in nearly $3 billion in net long-term inflows, which is decent.
Okay.
But if you look broader, include their fixed income ETFs and also their China-based assets, the number jumps closer to $10 billion for fixed income overall.
$10 billion, that's a big difference.
It is. It shows that while maybe traditional active fixed income is seeing some pressure, their more diversified solutions, especially ETFs and fixed income, are really hitting the mark.
Any big wins there?
Yeah, they highlighted securing the rest of a big UK mandate, the People's Pension, about $4 billion. That underscores their strength with big institutions, especially outside the US.
And private markets. Everyone's focused on alternatives as a growth engine.
They did okay there. Positive flows, over $200 million net inflows. A lot of that was driven by their real estate debt strategy, INCraft, which is now up to $3.5 billion in AUM.
How about private credit specifically?
It was a bit choppy. Saw some outflows early in the quarter when everyone got nervous, risk-off sentiment. But then it bounced back strongly in May and June. Pulled in about $1 billion in aggregate inflows over those 2 months.
So some resilience there too. That's important.
Very important. It's a high-growth, high-margin area they're really leaning into.
And you mentioned China earlier, their joint venture there, and India too.
Really strong. Delivered $5.6 billion in net long-term inflows combined. They hit a record AUM of $105 billion in that segment, mostly from existing products just gathering more assets.
Wow.
It just shows how well they're positioned in those key emerging markets, capturing those, long-term growth trends. Huge opportunity there.
Okay, but let's address the elephant in the room. Fundamental equities, still under pressure.
Yeah, that continues to be the tougher spot. They saw $3.66 billion in net outflows for the quarter.
Ouch. Where is that coming from mainly?
Mostly U.S. wealth management channels and some emerging market funds. It's that structural headwind we talked about, the shift away from traditional active management.
So is it all bad news on the equity front?
Not entirely. There were some bright spots. They actually saw positive flows in Europe, AMIA, and Asia Pacific. And one fund, their Global Equity Income Fund, had record net inflows of $2.44 billion.
Really? Where did that come from?
Predominantly from clients in Japan, interestingly. So it suggests that even though the broad trend is challenging, if you have specific strategies that are performing well and meeting a specific need, you can still win assets.
So a mixed bag in equities, but not a complete washout.
Exactly. Shows targeted demand still exists.
And how does the actual investment performance look across all these different areas? Because ultimately, that's got to underpin their ability to keep and win assets, right?
Absolutely critical. And the numbers here are actually pretty strong. Over half of their funds are performing in the top quartile against their peers over 3 years.
Top quartile over 3 years, okay.
And 46% are top quartile over 5 years. Plus, more broadly, over 2/3 of their total AUM is beating its benchmark over those same 3 and 5 year periods.
2/3 beating the benchmark.
Yeah, and they noted significant improvement in their 1-year numbers for fundamental equity specifically. So performance seems to be turning up, which is key.
That's crucial because strong performance is the best defense and offense for any asset manager.
Couldn't agree more. These numbers show that despite outflows in some areas, their investment engines are generally running well and delivering for clients.
Okay, so let's pull this all together. What does this quarter mean for you, the investor, looking at Invesco? Let's talk broader context.
Right. Stepping back a bit.
That QQQ reclassification proposal we discussed, it really feels like a good example of them being, well, strategically nimble. Management framed it not just as a technical change after 26 years, but really about modernizing the structure. Better outcomes for clients and, importantly, for shareholders.
And as we said, that potential 4 basis point revenue pickup they expect, that flowing straight to the bottom line is, pure margin enhancement, a very tangible shareholder benefit.
This also brings up the question of how they're juggling priorities. Are they focused on paying down debt, or are they focused on growth?
Well, management was pretty direct about this. They said they're not choosing, they're doing both.
Both deleveraging and growth.
That's the message. That preferred stock buyback. That was a key step in deleveraging, yes. But it also creates more flexibility, more dry powder for future capital allocation.
So what might they do with that flexibility? Acquisitions.
They said they remain very open to M&A, looking at inorganic opportunities, but they also stressed the bar is high.
Meaning they won't just buy anything.
Right. Partnerships like that MassMutual deal seem to be a priority, especially for building out private markets. And they also emphasize they're continuing to invest organically in their core strengths, ETFs, SMAs, and leveraging that big international footprint. They have, $600 billion in AUM from outside the Americas.
So diversifying their bets, really.
Yeah, multiple levers for growth.
One really forward-looking comment that caught my ear from the call was about the future of cash management. Invesco's a huge player there, and they directly acknowledge the rise of things like digital dollars, tokenized money market funds. This isn't just a side issue for them, is it?
No, not at all. They explicitly said they're actively focused on keeping pace with digital assets.
Yeah.
They see it as a key part of their sort of operating agenda for the future.
Why is that so important for a firm like Invesco?
Well, think about it. Cash management is a massive business for them. If the fundamental nature of cash starts to change with digital currencies, tokenization is both potential disruption and a huge opportunity, their proactive stance suggests they want to stay ahead of that curve, maintain their leadership. It's about managing money in whatever form it takes in the future.
So connecting all these threads, they see their diversity geographically across asset classes, public and private, as a real advantage. That $2 trillion AUM gives them scale, obviously, but they seem focused on using that scale to drive more resilient flows, revenue, and profit. Focusing on that positive operating leverage, controlling costs, even while they invest in upgrades like Aladdin, it does feel like they're building a more robust, all-weather kind of business.
That's a good way to frame it. Strategic investments, stronger balance sheet, optimizing existing revenue like with QQQ, strict cost control. It's a multifaceted approach. They want to be able to capture growth wherever it appears, from plain vanilla ETFs to the cutting edge of digital finance, while making sure it's profitable growth. Scale isn't just about being big, it's about being adaptable and efficient.
Okay. Time to play the game, that part of the show where we take all this analysis and spin out a provocative thought. Not advice, just a thought experiment for you, the experienced investor listening.
All right, let's do it. The outrageous but plausible idea based on this call.
Okay, here it is. Imagine pitching a tactical long-short trade within the asset management sector itself.
Interesting. Go on.
The long. You go long, Invesco. Why? Because this call, I think, really showcased a company firing on multiple cylinders operationally. You've got that flat expense discipline even while investing in critical tech. You've got the aggressive, smart balance sheet move with the preferred stock buyback, freeing up cash, signaling intent.
Right. The fundamentals look strong.
And crucially, the growth engine is hitched to the right trends. ETFs are booming, QQQM is a rocket ship, SMA is gaining share. And that QQQQ reclassification, that 4 BPs might sound small, but on that base, it's pure high margin gravy dropping straight to the bottom line. It's not just growth, it's profitable, operationally savvy growth.
Okay, that's a long case. What's the short?
The short. At the same time, you short a, let's say, legacy asset manager, one that's maybe overly reliant on those traditional actively managed higher fee equity funds, especially if they're very US-centric, less globally diversified, maybe weaker in private markets.
The kind facing those secular shifting demand challenges Invesco mentioned.
Exactly. The market is shifting. Clients want lower costs, they want diversification, they want alternatives. If Invesco is strategically positioning itself to capture those evolving demands, and this quarter suggests they are, then logic dictates someone else, someone slower, is losing out, facing fee pressure, outflows.
So the trade is basically betting on the divergence between the adapters and the ones who may be stuck in the past.
Precisely, betting on that accelerating gap. And the really outrageous part of the pitch, you highlight that seemingly tiny 4 BPs from the QQQ change, plus the strategic boost from the MassMutual partnership as the kind of secret sauce that just amplifies Invesco's edge. That extra efficiency, that extra growth lever that the legacy players might lack. It's a clean play conceptually on where asset management is heading. Scale, diversity, efficiency, win. Again, just a thought experiment. Not financial advice.
It's definitely provocative. Okay, so wrapping things up here, Invesco's Q2 call really did paint a picture of a firm navigating this choppy market with quite a bit of strategic skill. Big focus on the balance sheet, on operational leverage, and really leaning on that diversified platform.
Yeah, key takeaways for me were definitely the deleveraging, that preferred buyback is significant, the potential earnings kicker from the QQQ change, and just the continued strength in ETFs, fixed income overall, and that China JV, even while acknowledging the headwinds in traditional active equity.
And the call also gave us glimpses into their thinking on future M&A, how they're playing in private markets, and even their take on digital assets and the future of cash. They're definitely looking forward.
It feels like a company that's positioned to play offense now, not just defense, which leaves you thinking, right, with this added flexibility, how fast can they push into those high growth areas? What other, stones might they turn over to unlock more value? Lots to watch.
Indeed. Definitely want to keep an eye on.
Well, thank you for tuning in to Talk Tickers for this deep dive. We always value your perspective, so let us know what caught your attention from this call. Until next time, stay informed and keep a close watch on those numbers.